4 years. That's how long it took NewEdge Capital Group to climb from number 29 to number 3 on the Barron's Top 100 Independent RIA list. From $25 billion to $80 billion in assets in less than 5 years, with one of their founding partners telling me they're going to hit $100 billion by year end. But here's what you may not have known about two of the founders at NewEdge Capital Group. Before they ever entered wealth management, Alex Goss and Neil Turner were tech entrepreneurs who met at a New Orleans startup and co-founded a Silicon Valley-backed advertising technology company. If you're skeptical hearing this, I get it. Another tech star story about disrupting wealth management, right? But the more I dug into what they've built and how they built it, the more I realized something that makes me a little bit uncomfortable. Maybe our industry's insularity is holding us back more than we want to admit. See, we focus so much on hiring entirely from within wealth management. We only benchmark against other RIAs. We've convinced ourselves that only people who have spent 20 years at wirehouses and platforms can possibly understand how to lead businesses forward. But what if that's exactly the problem? Alex and Neil didn't know how things were supposed to work. They just looked at the problem fresh and said, why can't we build this differently? And that different thinking shows up everywhere. They split the business into two distinct RIAs, NewEdge Wealth, operating as a single brand with about 40 teams serving ultra high net worth clients, and NewEdge Advisors, a platform for independent advisors who maintain their own brands. A lot of people said that wouldn't work. They also created bridge programs that let those independent advisors tap into the ultra high net worth expertise when they need it. But here's what really got my attention. I couldn't find a single piece of trade press covering advisors leaving NewEdge, not one. During explosive growth where something usually breaks, their retention appears untouched. So in this episode of Growth Leaders of Wealth Management, I'm speaking with Alex Goss, founder and co-managing partner of NewEdge Capital Group, and Neil Turner, founder, chief revenue officer, and chief strategy officer. Growth Leaders podcast tells the stories of advisory firm founders driving differentiated growth, and NewEdge's story is unlike any I've had the privilege of telling before. Pay attention to how NewEdge thinks about being advisor first while recruiting billions of assets a year. Also pay attention to their technology philosophy. It's not about building, it's about integration. And especially pay attention to how they maintain culture during hypergrowth, because that's where many firms break. This conversation reminded me why I started this podcast. The firms driving real differentiation aren't following the playbook. They're questioning the assumptions. They're bringing fresh eyes to old problems. That's right now on Growth Leaders of Wealth Management.
You know, we're business partners, been business partners for a long time, but Neil was also my first boss. So fresh out of college, I met, Neil, also a serial entrepreneur. He and his co-founder of iSeats started iSeats. It was in New York City at the time. I was in New York City, and we met through mutual friends. They hired me, kind of as a, entry-level guy to start out, and I quickly fell in love with the entrepreneurial world. And Neil and I, had a lot of success at iSeats, and left there to start Evercar, and then both kind of went into the corporate world after Evercar, and then came back to to found and start what Goss Advisors has become today. So happy to go into kind of any of those businesses or whatnot, but we've been, for better or worse, working together for quite a while. So.
Did it feel like a big leap going from those sort of like that tech startup hyper entrepreneurial world with, VC backing to the wealth management business that was something that was a family business, right, Alex?
Yeah. So I'll let Neil answer, probably a slightly bigger leap for him. But I mean, what happened, the kind of the whole genesis is I was in New York. We just raised a bunch of venture capital money in San Francisco, and it was around the '08 period. The world was changing for, all the reasons we remember. And my father had been a financial advisor since the early '80s with A.G. Edwards. AG Edwards just been acquired by Wachovia, then Wells Fargo, and he had called me earlier that day and said, I'm done, I'm quitting, I can't stand working for it. It's the first time I've ever felt like an employee in my life. I'm going to get out of the business. So I was telling Neil and another friend in New York about this, and the other friend happened to be an investment banker. And he kind of like grabbed me by my collar, like, no, you can't let your dad just like quit. Like that's a very valuable business that he's created. I was like, he worked for a bank. It's not his business. He's like, no, it really is his business. I don't care what the bank thinks. Those are his clients. So I started researching, and I realized that it was a business that he created, a very successful one. So I left the company Neil and I had started to move back down to Louisiana to kind of help him shore things up. I bought another practice of one of his friends that similar concept didn't want to be in the business anymore. And we started growing that. And about 4 or 5 years later, after we had left and started our own RIA, I had all these people calling and saying, hey, look, like, I don't want to be at a wirehouse or bank anymore either. But I don't want to start my own RIA. Is there a way that we could like work together? So I called Neil, who was back in Delaware at JP Morgan at the time. Right, Neil, were you?
Yeah.
Yeah. It's like, man, I think we have an opportunity to build, a B2B business, a business for advisors to support advisors. There's a pretty gigantic gap in the Gulf South of anybody doing anything like this. Why don't you kind of start researching and see if we, maybe get the old band back together. So I'll let Neil kind of take it from here. It's probably a bigger jump for him because I had at least at this point had
right
6 or 7 years of being a financial advisor. But I definitely have missed my entrepreneur.
Yeah, I think, I've started businesses in online travel, rewards. I've done that at JP Morgan as well. And I think in advertising, and this is no different, right? Coming at something as an outsider. So you look at like, what are the challenges? What are the industry trends? What are the opportunities? How would you build something? How would you solve those challenges? What's different about what you're going to do versus what everybody else is doing? Then you kind of bring a fresh perspective to the industry that, people who have been born into the industry or sort of raised in the industry may not particularly see. So I think it's kind of an advantage in a lot of ways coming in from the outside and not knowing how things are supposed to work. So you actually build them the way you think they should work. And so yeah, it's been a lot of fun. But we wrote the business plan. It's going to go into growth a little bit. And when we had expectations of where we wanted to be, we made a commitment that, we would give this 2 years, and that in that time, we'd learn whether or not we really had a valuable business model. We went through those 2 years very quickly. We realized this was far bigger than we ever thought it could be. And we were blowing through our projections in terms of growth. We weren't necessarily blowing through our projections in terms of the cost to support the business. But yeah, it was a really exciting time. And we thought there was a great opportunity. All the trends were in our favor. Advisors moving independence, larger advisors moving independence like Alex's dad. And I think what I saw was, what Alex and his dad were trying to do, which is Alex sort of said, hey, Dad, if you want what's in the RIA space and you want that to unlock what it can do for our practice and our families and the clients, I'll kind of run the back office. I'll run the compliance and be client facing. Dad, you can kind of manage your clients and enjoy the business again. And Alex said, hey, look, I think there's a lot of people like my dad, larger, successful advisors who could all be their own RIAs, but aren't going to necessarily want to run them. And I thought that was the data back that up. It's been a lot of fun.
Neil just articulated something many in the industry won't admit. Industry experience can be a liability. When everyone around you operates the same way, you stop questioning whether that way actually works. You just assume it's the only option. This is why wealth management has been so slow to evolve. We hire from within, we benchmark against each other, and we've created this closed loop where the same assumptions get reinforced over and over. The wirehouses did it this way, so the independent broker-dealers did it this way, so now the RIAs do it this way. Alex and Neil were outsiders. This fresh perspective let them see something their competitors missed, a pattern where advisor platform businesses kept breaking at around $2 billion in assets, not randomly, consistently. There was a structural reason these firms kept hitting the same ceiling. What they discovered would become the foundation of their entire business model. Let's hear how they identified the flaw and how their competitors were structured. So what were some of those early insights that you brought from your other experiences into this new business that you and Alex decided to build together?
I think mainly belief. I mean, as 23 and 24-year-old at iSeats, my co-founder and I had beliefs around what you could do with online travel and online restaurant reservations, and no business necessarily or experience to back that up. And we were able to grow very quickly. We grew Advocar very quickly. And I remember saying, Alex, like, I'm confident based on what we're seeing that we can grow this really quickly, and we can, recreate something like an A.G. Edwards. And I think, that's probably hubris if you're coming from the industry, or it's grandiose. But I just believe that there was the opportunity. Maybe if you've been in the industry, you think, wow, that would be kind of impossible. Those firms only come around, once in a century. But we just had the belief that we could do it.
I think that another thing that he brought and helped us realize too is because I kind of said, look, I think I figured out what the advisors want, right? Like what the actual services are and the end product, and to some extent the revenue model. But, operationally, how are we going to structure this? How do we grow it and become, successful and profitable? And I think his ability to kind of go out and look at some of the competitors in the space at the time, this was around 2014, 2015. A distinct thing that he realized that we did was a lot of our competitors were like us. They were larger practices that tried to start this other business, and they borrowed from the client practice resources to run the business, right? They used their client service, so it was all the staff and everything they had to run a successful client business. They tried to borrow from to run in a business of supporting advisors. And that kind of broke down, and you can kind of see most of these companies, at least at the time, breaking at this like $2 billion mark. And so we made a decision not to use any of the practice resources, and instead we bifurcated the practice from the RIA into separate entities, and then invested in people, technology, marketing, and all the things we needed to do specifically into this platform. And that allowed us to just go so much faster and quicker than everybody else. Because everybody else, as soon as you get successful, say, well, my clients don't have enough resources, and there was this tug of war between sharing resources, and we had the flexibility to kind of to grow faster because our resources could grow with us.
Yeah, I think that's right. I think it's the same industry, but the end client's completely different. Servicing
Totally different.
a end client and an advisor are two different things, and people make the assumption that you can do both, and you really can't. And so you've got to pick your path. Do you want to serve clients, or do you want to serve financial advisors? And if you serve financial advisors, everybody who works there and everything that you do needs to be about servicing them and not somebody else.
What Neil just described is a fundamental business model choice that many firms get wrong. They try to serve both advisors and end clients simultaneously, convinced they can do both well. But the operations, marketing, service delivery, everything is different. Think about it. An end client needs handholding through market volatility. An advisor needs technology that integrates seamlessly and a service team that responds in hours, not days. An end client wants educational content about retirement planning. An advisor wants intel on custodian pricing negotiations and compliance updates. These are entirely different businesses. This is why those competitors kept breaking at $2 billion. They were trying to resource two distinct businesses from the same pool. Eventually, something has to give. NewEdge made a different choice from the beginning. They bifurcated completely. Jerry Goss's practice became their first platform client, giving them a laboratory to test what elite advisors actually needed. And once they got that model right, growth came faster than anyone anticipated.
We looked at some firms that we admired, but we thought there were opportunities to compete with. And they had gotten from, I think, the main one we looked at was 2008 to 2015, they got to $5 billion. So we thought, if we can be at $2.5 billion, this is sustainable. But within that first 5-year period, I think, Alex, what were we at with EdgeCo? Close to $10 billion?
Yeah, roughly. Yeah, we hit a $5 billion mark really in the first 2 years, when we were expecting, so it happened quicker. There's just more demand. We thought it was going to be regional and only people that like we knew. And as we kind of started going out to the market with the concept, and the concept really, I guess, which is important to understand, is that our firm and the niche that we wanted to play in was with successful advisors that already knew what they were doing, right? Our firm's mission wasn't to make you successful. Our firm's goal was, let's find already successful advisors and figure out a way to give them more time and autonomy to do what they're already good at doing. And I think most of our competitors were out there, join me because I've got XYZ special sauce that'll make you successful. And that'd been pitched to me and our contemporaries for years. And it's like, I don't need that. We already know how to get clients. We've got a big practice. Like, I need more time to do what I'm already doing, right? I need more margin so I can invest in more people so that I can grow and scale my own business. So, it was almost like we didn't understand how rich that vein was as it pertained to the volume of advisors that felt that way. And so, we grew by a smaller headcount and larger AUM, really, really quickly. Whereas like a lot of if you look at our competitors at the time, they were at 5 billion, they had 300 advisors, we had 30 or 40 or whatever it was, so it was, we knew we were onto something that was different, and had real kind of economic legs.
So from when you came together in 2014 to build this platform business to support these highly successful advisors, primarily coming out of the wirehouse space, is that right?
Yeah, we either coming out of the wirehouse or disenfranchised with like the independent brokers, having come from a wirehouse to a independent broker dealer and then like realizing they didn't want to do that anymore.
They didn't want to do that. Yeah. So from 2014 to 2020, I think what I read, you grew to essentially like 8 billion in assets under management on that platform business. And then how did the EdgeCo conversation come to be? Like, tell me about that moment in time, how all of these businesses came together and what you saw as the opportunity.
Well, we didn't build the business with the expectation to sell it. Really, like when we were starting to, private equity and institutional capital was, not as much of a prevalent theme as it is today. There were really only a few players in the space that had major backing at that point. Some of the big names like Hightower and Focus and maybe a little bit of Dynasty or something. But so our goal is just to build a company. And what happened is in around 2020, beginning of 2020, some of our independent advisors that we never thought would ever want to be anything other than independent started saying, hey, look, valuations are starting to go up. There's starting to be, real opportunities to monetize. And, we also want to get into the M&A space and buy practices and roll them up underneath us. Can you guys give us some money to do that? And we did that off of our own personal balance sheets or through bank financing, for the first year or two. But the demand kept getting bigger. The multiples got bigger. We realized, and then some of our competitors started taking, major jumps. The Carson Group took, Bain money.
Yeah.
Started taking, you had Beacon Point doing their deals with KKR and everything. So it started getting bigger and bigger. And we're like, we're going to get left behind if we don't shore up our balance sheet with some institutional permanent capital to allow us to grow inorganically. And while, still being able to, kind of focus on our core organic, growth engine. And so we were looking around and really what happened is you had, EdgeCo's a holdco. They invested in a retirement and trust division called, at the time it was called, Mid-Atlantic Trust Company. It's now been branded American TCS, but they had a broker dealer kind of and an independent broker dealer kind of as a offshoot of what had happened on the retirement side. So they needed some help running and better operating the broker dealer in the independent space. Simultaneously, we met Rob Sechin, who is my co-managing partner, who was the founder of Turnstone, which was like the third largest ultra high net, well, third largest practice, but third largest ultra high net worth firm at UBS at the time. And so we kind of realized if we could all come together at the same time, we could really be something special because there really wasn't a firm that had a place for successful advisors that could land, that were either ultra or non-ultra, kind of under the same roof. It was either, come here and become ultra or, wasn't fit for ultra. So, by all three coming together, that's what became the Capital Group. I think 2020 is when it officially merged. It's been a rocket ship since that happened.
And I would add, I think, we were at a place where Alex and I were doing the recruiting, and it was great to be part of a business that, there was more demand than we could ever get to, right? We couldn't return advisor calls fast enough. We knew there were more advisors out there who wanted to join us. And so we had this feeling like there was part of the market that was untapped that we couldn't get to because of capital restraints. And that if we could just have a little more capital to hire recruiters and bring onboarding folks on and all those things, the opportunity could be exponentially bigger. And I think the private equity firm was looking for firms that had incredible business models that just needed capital and some guidance to grow exponentially. And so it was a good fit.
The EdgeCo merger in 2020 brought together three distinct pieces: Alex and Neil's high-performing advisor platform, Rob Sechan's ultra-high net worth practice from UBS, and Mid-Atlantic Trust's retirement and broker-dealer infrastructure. On paper, it kind of looked like a mess. Three different cultures, different client segments, different service models. But here's what made it work. They weren't trying to force everyone into the same box. The structure explicitly accommodated different types of elite advisors: ultra high net worth teams who wanted a single brand, independent advisors who wanted to keep their own identity, and the capital to finally meet the demand they'd been turning away. More importantly, they were all targeting the same advisor profile: established, successful, growth-oriented, elite. Not advisors looking to monetize and retire. Not advisors who needed to be taught how to build a practice. Advisors who already knew how to win clients and just needed better infrastructure to do more of it. That focus would become NewEdge's competitive advantage. Here's how it translated into explosive growth. So when I think about NewEdge Wealth and these 40 teams that are working the ultra affluent space, they're marketing as NewEdge Wealth, as an RIA working with the end consumer, I would imagine that your growth is coming from specific channels in that business. And then when we look at NewEdge Advisors, where you're recruiting advisors to this platform business, that you're approaching growth in different ways. So how have you been so successful? Like, what have been those drivers of growth in both businesses that have proven to get you from the 25 billion in 2020 to 80 billion today? We're recording this in October of 2025, and you're telling me that you're going to end the year at 100. So what's driving the growth?
I would say, yeah, I mean, I think the most important thing is that whether you're NewEdge Wealth or you're NewEdge Advisors, it goes back to what we talked about earlier. Both RAs focus on elite advisors. If you're an elite, ultra high net worth advisor that needs the tools and resources to serve complex families and institutions, or high net worth advisor to more entrepreneurial, you've got to be elite. And elite advisors want to be in a home with people like themselves. I think other firms, while they won't take anybody, they're not as steadfast on holding true to the mission. So I think that's the key to some of our success. But Alex, do you want to add on that?
I think our model also attracts advisors that are not looking to hang it up, right? Like our model is like, we want to help elite advisors grow. So, I think the average advisor age across our firm is 49, which is pretty low relative to the industry average. So people aren't coming here to monetize and retire. They're coming here to kind of take their practice to the next level. So one, there's not a lot of firms out there that are competing in that space. Again, most of the firms are competing with, look what I have, and I will make, if you join me, you'll get access to what I have to help you succeed. Or in our world, they already have access to the clients. They just need more things to continue to basically take advantage of the the client opportunities, and prospect opportunities that they have. So I think being kind of singularly in that space where everyone else is focused a little bit more on the firm, we're focused on the advisor, gets us in front of, you'll see it happen. Like these advisors will come in, they got their hands crossed because they've talked to 7 other firms, and they just think, they're like, people don't get me. And by the end, they're like, how come I haven't met with you? I wish I met with you guys a year ago. And those are the type of advisors we want. If they don't say that, I don't feel like that, then, we don't want you. So I think that's important. People always ask us, like, what's our key to success? I genuinely believe we're really transparent and honest. Like, we tell people how we make money, where we make money, what it looks like to join us. We try to convince somebody. We are not trying to convince somebody not to start their own RIA. Like, we will tell you why you should start your own RIA if you should, or other firms you should go to. And I think that approach is refreshing. And lastly, I think we've really professionalized our outreach efforts in a way that others haven't. We brought in some of the best recruiting minds from around the industry to help run our business development team. We've got a process that gets us in front of a ton of opportunities, and our close rate is really high because we know how to get in front of the opportunities that we think are going to be a fit, and we don't waste a lot of time. And I think you see this with our competitors. They'll talk to everybody and anybody, spend a whole amount, a lot of time with 10 different prospects when really only 3 of them are probably a fit for them. Our goal and our team is told, like, you don't talk to the 10, just talk to the 3, tell the other 7 where they should go, and let's focus on the 3. And that allows us to, I think, establish who we are and get in front of more people, and the people that get in front of us are naturally more attracted to what we're selling.
And then the last is sort of the network effect, which is, advisor used to being sold, a bill of goods and arriving at a firm and then having it not delivered, right? That's their experience. That's why they're moving independent. So they're expecting the other shoe to drop. But I think when you join NewEdge Wealth or NewEdge Advisors, and not only do you get what they promise, but you get a lot more, they're going to run through walls trying to get their peers that they've left behind to join. They're going to be advocates. They're going to be on the phone with advisors who say, do they really deliver what they promise? And when you hear from another advisor and you believe it's true, that matters a lot more than anything we can do in terms of marketing. So you got to deliver, or you can't sustain this kind of growth.
What I've found that I think is just ironic in a way is that running this business is really not that different than running a client business, right? Like all the things that you need to do to be successful as an advisor, to attract clients and then get new clients and get prospects, it's the same thing. I mean, it's, we call it advisor first, culture. We're a fiduciary to our advisors, right? Our advisors are a fiduciary to their clients. So we just put the advisors first. We do things, we were talking about it just the other day, like we'll never do anything operationally that makes the firm more efficient at the expense of an advisor, right? We'll never say like, if the advisor could just fill out 3 forms, instead of 1 form, then we wouldn't have to take the 1 form and turn it into 3 forms. No, we're still going to let the advisor fill out the 1 form, and we're going to figure out on our end how to make it more efficient. And I think ultimately it's not the quick, fast route to success, just like building a client business, but long term, it is. And once it starts to eventually unlock, it unlocks in a meaningful way. And I think if anybody's built a client business before, they know that. That's what happened. That's how you build a client business. It's not that different really on building a financial advisor business.
Alex just described something that sounds simple, but most firms can't execute. Genuinely putting advisors first, even when it costs more or takes longer. For example, letting the advisor fill in 1 form instead of 3, even if 3 forms would be easier for the back office. That's not rhetoric, that's a fundamental operating principle. But here's the challenge. They're recruiting 15 to 20 billion in assets annually. They're serving over 500 advisors across 220 locations. At that scale, how do you maintain that level of service? How do you keep innovating fast enough to stay ahead of what elite advisors need? Because elite advisors have options. They could launch their own RIAs tomorrow. They could move to any competitor. The reason they stay and the reason they refer their peers is if NewEdge continues delivering something they can't get anywhere else. So what exactly are these elite advisors looking for?
Access is a big piece of it, right? Well, okay. So first, I really do believe it sounds chintzy, and every time we say it, everyone's like, "Oh, sure, everybody says that," but ignore it at your own peril. Culture is really important, right? They're looking. We said these advisors could be their own RIA. Anybody would want them at a firm. So finding a place where they feel like they matter and where the other advisors around them look and kind of feel like they do. We call it our no jerk policy. I mean, that's important, and it's qualitative. It's hard to pin down, but it's extremely valuable. And oftentimes, what ultimately drives the advisor to want to be with us first and foremost, and then kind of the next thing. So culture important. Access, I would say, to a variety of things: access to investments, access to technology, access to custodians, access to clients. Access is important, and access today is kind of expensive. The amount of money, technology, investment and scale that's required to get the non-commodity version of all the things I just described is pretty substantial. And even if you're a $1 or $2 billion team, you're not going to be able to. I mean, in the custody world, $2 billion's big, but it's not really that big anymore, right? I mean, you've got to be massive to be able to knock down pricing and managers and technology and all these things. So that's a big piece of it. And then support and consultation on how to do it, right? Like, because there's so much available out there now from a investment and technology standpoint. What do I use, right? They know what they want, but not the necessarily how to get what they want, right? So like, I want a better client experience. I want, AI, elements in my practice. Well, our firm is going out there and doing all the research and working with all the third-party technology companies, investment managers to kind of bring in and then say, okay, hey, here's everything out there in the space. What are you really looking for? Okay, I think these 2 or 3 are probably what you're looking for. And then the last piece is integration. Integration is because you want something, actually integrating it into your practice from a technology and operational standpoint, and an ongoing functional standpoint, takes a lot of work. And we have a lot of people in our back office that do nothing but those things.
They're looking for time. All of them are looking for more time. They're looking for more resources to grow their business and enjoy the business again, right? So I think we're really focused on making sure that elite advisors can have more time and, depending on the RA, the resources they need to not only grow their business, but sometimes, this is a really great business. You're helping people plan for retirement or plan for multi-generational wealth. It's fun, but a lot of the firms have taken the fun out of it. So we're trying to restore that part.
The relationship manager role Neil just described represents a genuine innovation in how platform businesses operate. Instead of managing advisors on behalf of the firm, these advocates manage resources on behalf of advisors. It's a meaningful structural difference. When you align incentives this way, when the relationship manager's success is measured by the advisor's growth, not by corporate initiative adoption, you create an entirely different dynamic. Advisors actually engage with these resources instead of working around them. This is the kind of operating model you can only build intentionally from the ground up. It requires different hiring, different compensation structures, different performance metrics. But here's where it gets interesting. How do you maintain this one-to-one advocacy model when you're scaling to 500 advisors across 220 locations?
We do have internal consulting and tech advocacy team, but I mean, a lot of what we're able to do all ties back to what we talked about at the beginning as being pretty myopically focused on a specific kind of advisor. Mm-hmm. So that helps with scale, right? We don't force advisors to be the same way by any means, but if you look at all our advisors, they're not that different, right? They're all kind of doing things the same way. They have the same kinds of clients, and they're trying to provide ultimately the same kinds of services to those clients. So, it's not like I have to, consult on 40 different, financial planning technology because they all want to do it a different way. Generally speaking, they all kind of need the same thing. So we're able to look at, and get pretty, proficient in 2 or 3 in each area, and then be able to bring those out to the field. And we're constantly doing webinars about, this is something else we just found or discovered. You might want to use it, and so it really kind of our ability. So we do have a team to do that, but in order to do it at scale, it's because it's pretty replicable across the. We're
Right.
not customizing
Right.
all 200. They can customize their own tech stack, but if you look at all 200, they're not going to be, that dramatically different from each other in what they're using and how they're using it.
And going back to the relationship managers, in other firms that we've seen, relationship managers are viewed as a mouthpiece for the firm, right? They're not really there to help you. They're there to push the agenda of the mothership and profitability initiatives. And then people stop using them for consulting, and they end up becoming an extension of like the customer service team, and where everything they're doing is putting out fires. So we call them advocates. The job of our relationship management team is to advocate on behalf of the advisor and for their needs, essentially see themselves as almost employees of the practices and not the firm, and try to get what they need done, and then give them insights that they need to grow or to manage staff or to integrate technology as if they're part of their teams. So we try to flip the relationship management model on its head. And what that ends up doing is that our relationship managers are not there to necessarily put out fires, they're there to actually help drive these businesses forward.
In the first half of this episode, you've heard how NewEdge brought together 3 businesses in 2020 and grew from roughly $25 billion to $80 billion in assets in just 5 years. How they structured 2 distinct RIAs under one roof, how they built an advocate model that actually serves advisors instead of managing them. But there's a harder question. How do you maintain culture during hypergrowth? How do you keep 500 advisors across 220 locations feeling connected to each other and to the firm when most of them have never met? After the break, we'll explore NewEdge's approach to community building, what's actually working for advisor marketing, and their bridge programs that are generating nearly $2 billion in internal referrals, plus where they're headed next. That's right after this. Pod Pony is the all-in-one podcast partner for thought leaders and business owners. They provide everything you need for your podcast, including audio and video engineering, graphic design, podcast social media support, on-site filming, and more. From initial concepts and strategies to production and distribution, the experts at Pod Pony are with you every step of the way. Learn more about Pod Pony by visiting podpony.com and start your podcast journey today. Now let's get back to the show. Welcome back. Before the break, we explored how NewEdge Capital Group built their Dual-RIA structure and scaled their advisor-first service model. Now I want to address what often breaks during hypergrowth: culture. Most firms talk about culture. They put values on the website, host annual conferences, send newsletters. But when you're adding billions in assets every quarter, when advisors are spread across the country, when everyone's busy serving their own clients, how do you actually create meaningful connection? Alex and Neil studied this question carefully. They looked at the advisor-first firms that existed before 2008. A.G. Edwards, Prudential, Smith Barney. They asked advisors what made those cultures so strong, and the answer surprised them. How do you create community amongst your 200 teams?
It's intentional, right? You don't just wish it to happen, right? So, I had the benefit of a lot of mentorship from my father, who was an advisor at A.G. Edwards, which, I think you put their community up against any community or culture of advisors. Anybody that ever worked for A.G. Advisors immediately starts to glow and talk about the good old days and how much they love that firm, right? So we I think early on, uh, misdiagnosed culture and community. And because because when we asked all those advisors, like, why did you love Edwards or Prudential or Smith Barney or Morgan Keegan, all these firms that don't exist anymore that advisors love, leadership, and that's what everybody said. Leadership is there and they care about you and they treat us first. And that's really, really important. But what I think we started to realize later on is that those cultures and communities still existed after the leadership, right? So like my dad still goes on trips with Edwards Advisors, all these, and so we started to realize that the community and the culture really was advisor to advisor. It's set and led by leadership, but it's if the advisors aren't connected to each other, you don't have culture or community, right? And then all you have really is a business relationship with an end client, and that tends to be only as good as the relationship, is, or the services provided. So we spend a lot of time getting our advisors together, just socially, just nothing about business. Just get together, bring your spouses, significant others, and just have a good time. We're end of this week is our national conference in Deer Valley, and it's going to be 4 days of just hanging out and having fun and laughing and having a good time. You'd be surprised when spouses or significant others become friends with other spouses or significant others, how tight that bond becomes. Like, you're not going anywhere. I love hanging out with so and so, kind of thing.
Right.
That's important. Community, of sharing ideas is important. So the whole the whole apple cart thing is true, right? The rotten apple can spoil an apple cart. So making sure you don't let people in that could impact your community or culture is a really important element to that. So kind of having all these advisors that I always like to say, like, when you join our firm, if you join our firm, the first time you sit down at a table with another advisor and talk to them for 5 minutes and feel like you've been friends for 15 years, like that's important. So that instant connectivity and commonality is important. And what we try to do is we try to get them together and just share ideas. I mean, they're already successful. Far be it from me to tell them how, what best ideas are. I mean, our number one asset is our advisors. So we have events throughout the year, and we call them advisor councils, where we just get them together. We throw them in a room, and we basically say, discuss, and we'll just pull up topics, and it could be anything from organic growth to vacation policy for your staff to, birthday gifts to clients, or, how to train a junior, or, and then
Succession.
talk, and, those type of things are, I think where they find connection, to each other more so than, I'm not going to create culture or community with newsletters and webinars and, things of that nature. It's, you got to get them together. They got to feel like they're part of something.
And going back to the elite aspect of it, I mean, any social organization that you join, if you were to enter a room in that social organization and there were people with different values at different life stages with different needs and different attitudes, you'd wonder what brings that organization together. But if you were to join an organization where you felt that everybody's in your life stage or could add value to what you're doing, they share the same values, that club becomes more powerful. And I think, when advisors, as Alex mentioned, join us and enter a room with people at the same stage, whether they're mid-career or they're trying to solve the same challenges, they can really benefit from one another. Nothing against advisors that are learning the business. They can do that within one of our teams. But for an advisor who's really experienced to go to a conference and sit next to an advisor who doesn't know how to get clients yet or hasn't experienced anything like they have, it just doesn't add as much value. So we have to be meticulous again on making sure it's the right elite advisors.
Neil just made a critical distinction. Elite advisors don't need general networking. They need peer groups solving the same challenges at the same scale. When you're managing $300 million in assets, advice from someone managing $30 million isn't particularly relevant. But someone else at $300 million who just solved your exact succession planning problem, that's invaluable. This is why NewEdge invests heavily in getting advisors together in person, not for training sessions or product pitches. just to build relationships, spouses included. Because when your spouse becomes friends with other advisors' spouses, you're not going anywhere. And here's what's interesting. This same principle applies to how these advisors are successfully marketing to their own clients. The strategies that are actually working might not be what you expect.
Everybody kind of tried the social, digital, marketing effort. I haven't heard anybody that just was like, in fact, like, oh, Facebook or Instagram got me like, did anything. I think what we've started to see advisors being more and more successful is, and again, our advisors are already kind of successful, is doing more similar to what I was talking about for our advisors, social events for their clients, doing things for their clients, getting their clients together, providing fun outside of, business activities for their clients has been, I think, the most predominant successful, followed by adding in additional services to the business that haven't always been there, like actually having in-house tax and estate.
Right.
So like making sure and marketing those services to their clients, their existing clients are then telling their friends, oh, I can actually just do everything under one roof. So I think a combination of those two things, like really, again, like I said, it's ironic about building an advisor practice or a client book. I think not neglecting your book and spending a lot of time getting them together, talking about each other, because they're going to, as Neil said, be advocates for you. Now, I do think digital is working to some extent. I mean, we have some advisors that are pretty heavy on LinkedIn and in other areas. I think I don't know if you'd call it marketing or not, but a lot of we do have some people using a lot of those like lead gen AI
Sure.
kind of technologies to find opportunity. So that's, I think, can be very powerful, but it's only as good as the advisor's willingness to follow up,
Make it work.
right? So it's not that different than 15 years ago when you could buy a really qualified call list of prospects, right? Like,
Not much different.
yeah, I mean, somebody still had to pick up the phone and call them all, and 100% of them weren't going to be clients. So like, it still takes effort and some kind of talent to be able to take advantage of those opportunities.
Mm-hmm.
But those three things are probably the most.
I think to Alex's point, individual practices are buying, lead gen, but they're typically competing against enterprises, massive firms.
Yeah.
I don't want to name the names, and you're meeting with clients, you're running a business, and by the time you get back to that lead, 2 or 3
Forget
other
about it.
massive
They have a
firms,
whole business development team that calls
got a
them
whole
within
business
7
development team that's
seconds.
called it.
Yeah.
So those things are working, but it's very difficult to work at an individual practice level. And to Alex's point, unless you've got somebody there dedicated to responding very quickly with a very concise pitch. So
it's not just responding with a concise pitch; it's having the whole marketing plan for how do you, not just, oh, I got a lead. It's okay. What's the 10-point plan to once you get a lead to, because more than likely the lead's not going to convert anyway in the first 30 days. It might be a 2-year drip campaign that you're going to have to apply to that lead, and if you don't have the ongoing strategy to do that, like a lot of these other firms do, you're kind of just throwing darts. There are some firm initiatives too, but I mean, so part of what we do is we try to get the best ideas from all advisors, and we'll have, webinars or best practices, or our advocates will go out, and when they're talking with teams, like, oh, I talked to, Joe or Sarah in Tulsa, they did this micro event and they got 10 million out of it, and this is how they did it, and so they're sharing those ideas. That's been important.
What you're hearing is a systematic approach to organic growth intelligence. NewEdge isn't yet running centralized marketing campaigns and pushing them down to advisors. They're collecting what's working across 500 advisors, identifying patterns, and redistributing that knowledge through advocates and peer forums. It's an innovative model when compared to other platform businesses where corporate decides the marketing strategy and advisors either adopt it or ignore it. The NewEdge approach only works because they've recruited advisors who are already successful at growth. These are elite advisors, but they've also built something more innovative. internal referral programs that let advisors access expertise beyond their own capabilities without losing the client relationship. These bridge programs are generating nearly $2 billion in assets in just 24 months. Here's how they work.
I think most of our advisors are successful because they, which I think is really a key to being successful, they have some kind of niche already that they've, you don't get to where you are just by, randomly catching clients. And
You don't get the top 10%. Yeah.
yeah, I mean, they've kind of figured out like there's a, a firm or an enterprise in their market that they've become incredibly knowledgeable about. They're focused on dentists, they're focused on whatever. They have some kind of niche, and that's kind of their bread and butter of how they grow. From a firm standpoint, now we do have programs that help add kind of fuel to the proverbial fire. I'll talk about one that, Neil runs all these, let him talk about them too. But, I think the one that's one of the most exciting ones is we call our bridge program.
Right.
Again, we have the ultra side and the non-ultra, and the non-ultra advisors are highly capable of handling, sub 30,
Family office style. Yeah.
sub 30 type households. But what's happening across the country right now is there's just an incredible amount of wealth creation, not that different than the financial advisor world, largely through intellectual capital, institutional capital. If you're a dentist, there's private equity companies coming in and buying dental practices for millions. You own a gem, it could be sold for millions. So all of a sudden, you have advisors that focus on that 2 to 20 that might have a $5 million client that suddenly becomes a 50 or a 60, right? And they know they may not be particularly equipped to handle that level of need, or they're competing against now, whoever's investment bank brought in their, SWAT team of experts, so they're now going across the aisle to NewEdge Wealth, bringing that team in and working to win the client. And we've seen, I don't know, what have we seen, Neil? What's our, since launching?
I think by the end of this year, we'll have nearly, hopefully around 1.8 to 2 billion in closed business in just a 24-month period. So,
wow.
a massive,
which is about the same size as most firms, like assets they're getting from a custody referral program,
Right.
like Ross or Sand. So we kind of almost have this internal, custody referral program that nobody can take away from us, or raise the
Nobody
minimum
can
bond.
change range of the minimums
Yeah,
and
exactly.
make you pay 25 bips for life.
Yeah, exactly. So, that's a pretty powerful thing. And it's also really neat because now you're seeing, these ultra advisors and, kind of advisors that are more in that 2 and 20 range, really working hand in hand together and excited to work together. It's been pretty cool to see. But then, Neil, if you want to talk about some other...
You'll see, we'll have, let's just say you're $500 million high net worth team in the mid-Atlantic, and you've worked with the ultra high net worth bridge program to open up a $200 million opportunity that you couldn't have won on your own. Now those teams are going back in their community saying, hey, look, I can help, anybody from the 1 to 20, but I also have a multifamily office for, 20 million and up. So now they're just expanding their capabilities. And those advisors aren't necessarily handing over the opportunity. They can sort of co-manage it in a sense with NewEdge Wealth and be part of the process the whole way, or they can refer it off if they want to. So there's lots of ways they can engage. But to Alex's point, we focus on, elite advisors who have grown something substantially. They're looking for more resources and time to accelerate that growth. And so largely, to your point, our teams have been the organic growers on their own, and our organic growth competes with anybody in the space. Now we're adding on these firm programs like the Ultra High Net Worth Bridge, plus what we call partnership referral programs, which are lead generation programs with custodians who have retail branches. Not going to name them out loud, but I'm sure you can guess who they are, to add additional growth to those advisors. And then to our point earlier, which is while individual practices don't necessarily find investment in digital to be beneficial for themselves in terms of buying lead gen, because they don't have that professionalized business development layer, we're now going to be looking to expand into digital marketing as an organization and then sending the leads that our professional business development teams generate to teams that are with us. So phase one, rapidly growing, successful teams, adding resources and time to help them accelerate growth. Phase two of our evolution is the bridge program and different tools the firm can do to drive, as Alex said, fuel to the fire. So what we don't want is advisors to come here because they can't grow and we have all these programs. We want to add growth to,
Right.
to fast growing advisors.
Right. You also have a retirement bridge program.
Yes, we do. So we've got American TCS, which is, one of the largest retirement platforms in the country. I think 60% of retirement plans touch them in one shape or form. We've got a lot of great advisors here who are hybrid, who focus on retirement and wealth management. And they believe those are symbiotic. And we have a lot of great advisors, I'd say the majority, who have a lot of opportunities in the retirement space, but they're not experts and they don't want to dabble in things that they can't be great at, nor do they have the time. And so we can leverage our retirement division to help them win those opportunities, keep those opportunities, and then get retirement opportunities from the executives down the road without them having to do the heavy lifting. And that's been successful as well.
The bridge problems solve an internal challenge: how to keep clients in the NewEdge ecosystem when their needs evolve. But there's an external brand challenge that's more complex. NewEdge Wealth operates as a single consumer-facing brand. Those 40 teams need clients to recognize and trust the NewEdge Wealth name. But NewEdge Advisors is a platform where most advisors maintain their own brands in their local markets: Smith Wealth Management, Johnson Financial, whatever they've built their reputation on. So how do you build consumer awareness for a firm where most advisors don't actually use your name? And as they shift towards corporate lead generation, where NewEdge would be sourcing clients and distributing them to advisors, does that change how they think about their brand? Here's their approach.
I think it's a big initiative for us to continue to expand the brand, right, to a consumer, from a consumer awareness standpoint. I think we've, to give Rob Sechin a lot of credit, he's on TV a lot. He already has, he had a kind of presence, and Cameron Dawson, our CIO, is on TV all the time as well.
She's remarkable. Yeah.
Yeah. I mean, so they've been incredibly valuable in helping get the NewEdge name out there. A lot of our marketing efforts and focus now are, and in the near future, are going to be geared towards making sure clients understand that NewEdge is a place for elite advisors. That's what we still don't, it's nuance, right? We don't want clients to want to work with NewEdge. We want clients to want to work with NewEdge because the advisors at NewEdge are elite, right? That's kind of the twist. So we're not trying to create a brand that wins clients. Our clients are here because of our advisors, but we do want to we want clients to understand that, we're kind of the best of the best when it comes to advisors. So that's our goal. A lot of our marketing efforts, over the last 5 years have gone into advisor recruiting and,
Yep.
Growing the business. Now that we really do have national footprint and are starting to gain, some decent national client awareness, our marketing efforts are shifting towards towards
that be more. Yeah.
the B2C side, right? Because it's great that we're in periodicals and RIA biz and all this stuff, but no client on earth has ever reads those things. I'm excited when I see my name in there, but
the Barron's rankings certainly help. I mean, that's a very consumer-oriented
form.
brand, and you have been marching up that list, and that goes a long way.
Exactly.
But I think, I'll be curious to follow along that journey. I think that there's a lot of opportunities, a lot of challenges, and a lot of misperceptions when it comes to building out sort of the consumer digital lead gen side. But to your point, Alex, about it being, it's an advisor first business. You've both mentioned that a number of times. And I do think that there are opportunities when you think about how can you really elevate the individual advisor and the individual advisor teams through your digital efforts, but supported by the corporate brand, that can be quite powerful. So I'll be excited to follow along. The brand conversation points to something bigger. NewEdge is shifting from a purely advisor-driven growth model to a hybrid model where the firm itself will be generating client opportunities. That shift matters because of where they're headed. NewEdge has publicly stated a goal of $165 billion in client assets within 5 years, essentially doubling from their current trajectory. For context, that would put them firmly in the league of the very few top mega RIA platforms that exist today. The math only works if multiple growth engines are firing simultaneously. So let's break down how they plan to get there.
I don't know who gave that quote, but I back it up. Whoever said it, I think we can get more than that. So no, I mean I think look like our recruiting right now. I mean we're bringing in. We'll probably have, I don't know what the end year number will be, but it'll be
I mean,
somewhere
probably
between,
it's close to 20 billion.
just this last year in recruiting. So through recruiting and M&A, because M&A is a big piece of what we do. So, if we bring in, call it 15, a year to 20 a year, that's, one way to get there. Our existing asset base, just the law of large numbers, right? I mean, 80 billion grows by 10%, 100 billion grows by 10%, you're adding, a lot of just organic growth through the market and organic growth. And then I do think that there's, could be some opportunity for some mergers of like-minded firms happening over the next 5 years. I think there's been less of that than people maybe expected, and I think there might be still less of that than people do expect going forward because it's the merger element really needs to be strategic. It's far more economical or profitable for us to just go acquire a $1 billion team with 5 advisors that are all on board and excited about the transaction and maybe only 2 real decision makers, and a decent amount of EBITDA to purchase versus a platform. I got to, maybe the senior executives are excited about it, but then you got to get 50 or 100 advisors excited about it. They may not have any monetary incentive for why this merger is happening. And, just for those reasons, like it really needs to make sense, right? I think you've seen that with some of the acquisitions that have happened at even the large fortune level recently. Like, advisors aren't just going to go somewhere because they're
Right.
right? So it's got to make sense. And I think we're starting to see that there's some areas where we have some strategic opportunities where a couple other firms really could fill some interesting gaps for us, kind of a merge versus build. So, you add a couple of those firms in the 20 to 30 billion range, it's, I'll say 200 by 5 years. So I'll say
Okay.
that'll be my.
And I think the other thing that Alex and I and Rob and John Strauss are super excited about is the coming together of the, having an ultra high net worth and an incredible high net worth firm side by side, and sharing and intellectual capital resources, sharing and lead generation opportunities, sharing ideas between the two, is just now coming to fruition. And the results that Alex was talking about in the bridge program, I just think if we can continue to replicate that success, we're going to become, a true destination for both those advisor sets, not just a hidden secret, but somebody that's well known throughout the industry.
Yeah, and the question about what am I most excited about? I'm most excited about the optionality that advisors are going to have, really starting to have, and will have over the next 5 or so years. I've said this before, but I think what happened in '08, really killed the culture firm option that advisors had. There was 30 or 40 really great firms before '08 that advisors, generally speaking, loved to be a part of. And then in a moment, they all went poof and were owned by 4 or 5 multinational bank-owned, firms. And that didn't change the need for those firms. It just changed where and how they were going to build. And I think what you're starting to see is the reemergence of those, we used to call regional broker-dealers, we would call them, but really culture firms, advisor-first firms, kind of reemerging through this custody RIA channel. And you're going to probably see 20 or 30 national players, a lot of the names we probably are aware of today, that are going to be of really, really significant size and scale, kind of back to that. I mean, those firms that was back in pre-08, and they were, 3,000 to 7,000 advisors and 500 billion of AUM. So I think you're going to see that, right? I mean, we're at 100, we'll be at 500.
Right.
And we'll be one of those 20 or 30, and there'll probably be another 20 or 30, about our same size and scale, but we'll all be a little different, right? We'll have our culture and we'll do our thing, and the other ones will have their culture and do their thing. And that's going to be really great for advisors because they should be able to have their cake and eat it too.
Right.
To be with a firm that they're excited to be with, that gives them everything that they need to be, to successful with their clients and feel like they matter. It means we don't all have to be everything for everybody. So that's kind of what I'm most excited about, is what the future that advisors have in front of them.
What are you most excited about or looking forward to, Neil?
I think that, we started this, as we said in the beginning, with an aspiration of recreating the advisor first firms of the past that largely disappeared. We had ambitious goals, but and we probably really wanted that to happen. But I think, to Alex's point, like, we really feel like it's in reach. I mean, we do believe that we can create a 100-year firm. We do believe others will do the same, and that this is the new golden age for advisors. This reemergence of these advisor first firms on the custody RIA platforms versus the traditional models of wirehouse banks and independent broker dealers. I think it's, I don't want to jinx ourselves, but we can't recreate an A.G. Edwards, but we would love to create something similar. I think we can.
At the beginning of this episode, I told you about my initial skepticism when I learned that Alex and Neil came from tech startups. Another tech to wealth management disruption story, right? But what they've actually built is something different. They're not disrupting wealth management for the sake of disruption. They're recreating what was lost in 2008 when many of the advisor-first firms disappeared. A.G. Edwards, Prudential, Smith Barney. The firms where advisors built their entire careers because culture and support actually mattered. NewEdge's innovation isn't technology or process, it's structural. 2 RIAs under one roof serving different advisor needs and wants. Relationship managers who work for advisors, not corporate. Bridge programs that keep clients in the ecosystem when needs evolve. A business model where the platform grows by making already successful advisors even more successful. And here's what I believe makes their $165 billion in assets goal credible. They're already recruiting $20 billion annually. Their existing base is compounding. The bridge programs are generating $2 billion in internal growth, multiple engines all accelerating. Alex believes we're entering a new golden age for advisors, where firms like NewEdge give elite advisors the optionality they had before 2008, the ability to join a firm with real culture and real support without sacrificing independence. That's the future they're building towards. And based on what we've seen, I think NewEdge is very well on their way. If you love this episode or learned something interesting, I'd really love to hear what resonated with you from today's conversation. I hope that you'll find me on LinkedIn and share your key takeaways. I would also love it if you would leave us a review. Ratings and reviews are always appreciated. At Ficomm Partners, we're on a mission to help advisory firms achieve the growth you're capable of. We serve as your outsourced CMO and marketing department, driving marketing-enabled organic growth through strategy, execution, and advisor coaching. For more valuable growth resources, visit ficommpartners.com/insights. Please subscribe to the podcast and on YouTube so you can continue learning from inspiring growth journeys. I'd like to thank today's guests, our producers at Podpony, production assistant Molly Spina, and my always amazing executive assistant, Kristen George. This is Meg Carpenter, CEO and co-founder at Ficomm Partners, and your host of Growth Leaders of Wealth Management.